According to NYU economist Edward Wolf, the rich will always be more likely to win during recessions. Wealth and income disparity rise during recessions. And as economist Hilary Hoynes and others have demonstrated, business cycles have a greater impact on the poor and indebted households. But fret not, because in this video, we'll show you the top 15 underrated stocks to buy in 2022 to help you profit from these recessions. So subscribe to Usable Wisdom and turn on the notification bell to get notified anytime new videos are uploaded. Without further ado, let's proceed to the list. Number 1. Airbnb. Price right now, $119 per share. Airbnb has dropped 44% in the last 6 months and is now trading for less than $120 per share. This was a corporation that was meant to be wiped out by COVID, but it still made $6 billion in revenue last year. We don't expect the stock to stay under $200 per share for the next 12 months, offering investors at least a 50% return. This is a company we admire, with a product we use, a vision for the future, and over $2 billion in cash flow from operations. Number 2. Adobe. Price right now, $395 per share. Adobe stock has fallen 42% in the last 6 months, and it now trades for less than $400 per share. This is a highly profitable business in an industry that is expanding at a quicker rate than ever before, with products that are constantly improving. We foresee a revision back in the next 12 months, with at least a 40% return for investors. With the development of Web3, digital will boom, and we're getting big on companies that will help shape this new market. Which leads us to our next pick. Number 3. NVIDIA. Price right now, $166 per share. The type of software NVIDIA generates will determine the future of our business, which includes gaming, VR, AR, and metaverse worlds. These niches are developing exponentially faster than anything else, and GPUs are critical to all of them. NVIDIA is the Goliath in this field, and there's no way they won't bank in the next decade. Stock prices have dropped 46% in the last 6 months, and the stock is currently trading at $166. This is a company with an average profit margin of 36% and revenue over $25 billion this year. In the best case scenario, you'll double your money in the next year. In the worst case scenario, the stock will trade at around $160, so there will be little to lose. We're excited to see if we're correct on this one, especially because the next firm will be utilizing NVIDIA's technology. Number 4. Unity Software. You must have a handful of these in your portfolio that can outperform everything else. Unity and Unreal Engine are the two biggest participants in the world of gaming engines. Even though Unreal has infinite funds, Unity is the underdog that is holding its own. Its software enables ultra-realistic graphics. We anticipate that in the next decade, we'll enter what's known as the uncanny valley, a technological point where you won't be able to distinguish if what you're seeing is a real human or a computer-generated image, and Unity will play a key role in that. Unity has dropped by a stunning 82% in the last 6 months, with the share price hovering around $30. This is an ideal asymmetric risk situation in our opinion, with the potential to provide incredible returns for investors over the following 12 months. Number 5. Nike. Price right now, $109 per share. You should invest in the firms that produce products you enjoy. Don't sell until their products are no longer meeting your demands. You'll be alright in the financial world if you remember this rule. Nike is well known. Despite their size, brand power, and reputation, they were caught in the same market crosswinds as the rest of us. They've dropped about 40% in the last 6 months. When all of this nonsense fades, the stock of a firm that has continuously growing sales year after year, a company that brought in nearly $45 billion in revenue last year, will rebound because any type of corporation with this type of brand loyalty will be able to pull through. You should expect a 50% or more return on your Nike investment in 12 months. Number 6. Under Armour. Price right now, $11 a share. Under Armour's stock has dropped 60% in the last 6 months. They're a fantastic business. We admire their underdog status and the creativity required to compete with the big guys like Nike and Adidas, and they're succeeding admirably. They're able to stay competitive by having a lower profit margin of 6% compared to Nike's 12%. This is the kind of strategy you use to break into a market and establish a brand. The revenue of $5.6 billion does not lie. In terms of 12-month forecasts, we see the stock returning to the $20 level, at which point we may contemplate partially liquidating our investment. Number 7. PayPal. Price right now, $76 per share. PayPal handles 22% of all online payment transactions in the United States. Despite this, the company's stock has dropped 65% in the last 6 months. Only 10 months ago, the all-time high was $300 per share. And today, the same share is trading for roughly $75. This is a corporation that made $25 billion in revenue last year and is expanding all around the world as more individuals have access to online marketplaces. Do you know what Venmo is? PayPal, as part of its payments ecosystem, actually owns it. With e-commerce on the upswing and online access rapidly expanding into markets where it has never existed before, we believe PayPal has a solid case to persist. Number 8. Square. Price right now, $78 per share. Square was founded by Jack Dorsey, the pioneer of Twitter, and is one of the entrepreneurs. Square's stock has dropped about 70% in the last 6 months, and it is presently trading below $80. The company is profitable, and with Elon Musk's acquisition of Twitter, Jack is focusing more on the Square, so investors could expect a return on their investment in the coming year. Number 9. Spotify. Spotify was trading for under $100 a share when the tech collapse hit. They raised $1.5 billion in funding last year, and the company looks a lot better on paper than the market suggests. And yeah, they are one of those businesses that loses money every year. However, the number of paying users continues to rise year after year. Spotify has created a name for itself despite competing with Apple and Google. We believe they have a chance to return 50% or more in the next 12 months. Number 10. Coinbase. Price right now, $66 per share. Coinbase, the largest authorized cryptocurrency exchange in the United States, is currently trading at $66, down from $350 in November. In the last 6 months, the stock has dropped by 80%. This is a fast-growing business in an emerging sector with profit margins of 25 to 50%. The number of users is increasing, revenue is increasing, and profits are increasing. Yet, the stock is declining. For those of you who are interested in financial research, their profit-to-earnings ratio is 5.6, which is fantastic. We believe that crypto is here to stay at this time. This is a great opportunity for individuals who want to learn about crypto but don't want to become bogged down in the many wallets, coins, and exchange platforms. We predict Coinbase stock to trade above $200 per share after the crypto bear market is ended. Number 11. Palantir. Price right now, $7 per share. Palantir, which makes software for national-level organizations, has dropped nearly 70% in the last 6 months. One of their most important clients is the United States government. The new world war is one of technology. We predict that China will overtake the US as the world's leading superpower. But the US will not go down without a fight. Palantir will play a key role in this since high-end technology is their only hope. They're also the type of business that can afford to lose money continuously as long as the state benefits. And despite losing $500 million last year, they have the resources to cover it and contracts to keep the cash flowing. In terms of pacing, we predict the stock to rise back above $10 per share. If you get in before then, you should make money in the next year. Number 12. Netflix. Price right now, $175 per share. Netflix's stock has plunged 75% in the previous 6 months. Although the company is producing more money year after year. Although other firms are carving out their position in the streaming industry, there is no reason to believe Netflix is undervalued. So all that remains is for the market to correct upward. Number 13. Walt Disney. Price right now, $105 per share. Disney Plus is rapidly spreading across the globe, giving Amazon, Netflix, and HBO a run for their money. The stock has dropped 35% in the last 6 months, and this is an especially attractive price point because Disney stock has returned to its 5-year low. Last year, Disney made $67.4 billion in revenue. And as their digital business expands, profit will become increasingly important. It's difficult to make predictions with Disney, but we don't see the stock falling from here. We anticipate above 50% returns for investors in the next 12 months. Number 14. Starbucks. Price right now, $70 per share. Starbucks stock has plummeted 35% in the last 6 months, from $115 to around $70. Everything seems terrific from a business standpoint. The corporation recovered well post-COVID, bringing in over $30 billion last year. If we believe that once the world returns to normal, more people will engage with Starbucks, we are correct. People do not want to return to work, but they do want to leave the house. Starbucks has a culture of entrepreneurs, writers, and designers working from their coffee shops, which ties in nicely with the present story. They also provide good coffee. We're treading gingerly here, depending on how terrible inflation develops. We may witness a second drop in the price when rents and commodities costs rise. Number 15. UiPath. The final company on our list is involved in automation. Bots are being developed to take the place of humans in global corporations. Although the stock price has dropped by 76% since its IPO, things appear to have settled down in terms of operations. The company now has co-CEOs who are responsible for different growth divisions. And after the dust settles, we should see steady upward development. We expect the entire business to flourish as AI continues to aggressively take over basic functions. We anticipate that UiPath will return more than 70% to investors within the next 12 months. We recommend that you go through this list and choose 5 stocks that you trust. Thank you for watching. I hope you gained some usable wisdom from this video. If you did, go ahead and hit the notification button and then subscribe to this channel. That way, you'll be updated anytime we upload life-changing videos like this. Until next time, see ya!